Lecture 2. In this lecture, we start to construct financial statement. So in this lecture, we're going to cover how we're going to record financial transactions into journal entries. Here we have this accounting equation we have seen from lecture 1. Assets equal liabilities plus stockholders' equity. In other words, that's investment equals money we borrow and the money invested by shareholders. Right? It's always balanced. It's always balanced. Now we're going to study these accounting equations on the balance sheet, how we record assets. So what are assets? How do we record assets? What are liabilities? What are stockholders' equities? So let's start with assets first. So what are assets? Assets are resources that are expected to provide a company with future economic benefit. Some key terms. They must be owned or controlled by the company. In other words, we have legal title or unrestricted right to use the asset. So if you borrow my car, okay, for a couple of days, that's not your assets because you don't have the legal title or unrestricted right to use a car. However, if you sign a lease contract, okay, and the lease contract is give you some unrestricted right to use, then you may have a chance to record it as an asset under the lease contract. Second, okay, it must expect future benefit, give you future benefit. Something that cannot give you future benefit cannot be reported as an asset. For example, you have a machine that you never used and you will not use it. Okay, you put it into warehouse and never use it. So this machine will never give you any future benefit. So you have two choices. You can either report it as an inventory and can sell it, or you're going to fully write the value down. Okay, but you cannot report it as your asset on a balance sheet because it has no future benefit. In another example, so you paid $10,000 for next 6 months' rent. Okay, that's prepaid rent. You paid $10,000. Can they provide you future benefit? Probably yes, right? Because you paid $10,000 you can enjoy for the next 6 months your apartment. Therefore, it can be reported as an asset. Prepaid rent is your asset. In another examples, you paid $600 for last month's rent. Does it have future benefit? Last month's rent? Probably not, because you have already enjoyed last month's apartment, so there's no future benefit. Therefore, $600 paid is not your asset because the benefit has been consumed. It becomes your expense. The $600 is your rent expense. So that's a difference. So why do we acquire assets? Because, right, future benefit. And how do we report assets on the balance sheet? Here we have an example for target, right, balance sheet, and for a specific date. So for these asset sections, we start with cash equivalents, inventory, other current assets. So the first 3 items, assets, are current assets, followed by 3 non-current assets: property, plant, equipment, operating lease assets, and other non-current assets. And then we have a total asset. So next we're going to study what are current assets and what are non-current assets. Right, so current assets. Current assets are assets expected to be converted into cash or be used in operations within the next year. Or within the next operating cycle. Right? For most companies, within the next year will be a good criteria to determine whether it's a current assets or not. It will be used within a year, that's current assets. Over a year, that's long-term assets. But for certain industries, because their operating cycle will be longer than a year. Operating cycle means, right, it's a cycle, you spend cash, right, you purchase, or you manufacture, you sell your product, and you collect back your cash. That's operating cycle. For certain industries, its operating cycle will be longer than a year, like shipbuilding industry. It will be longer than a year. For those industries, right, an asset expect to be consumed within 20 months, still have a chance to be reported as current assets. But those are special cases. For most companies, within a year will be a good criteria. Current assets are reported on the balance sheet in order of liquidity. So the most liquid asset will be reported first. So cash is always reported on the top of the balance sheet. Next, we have the non-current assets. Okay, those are assets not expected to be converted into cash or be used within the next year. They also can be called as long-term assets. Long-term assets. Right, so let's talk about common account for current assets. First, we have cash, right? Cash, currencies, bank deposits. So certificates of deposit and other cash equivalents. So here we have cash equivalents are like cash, but they're not cash. Cash equivalents are very short-term investment, virtually have no risk. For example, at the U.S. Treasury, okay, we can purchase U.S. Treasury, we can sell them anytime with virtually no risk. Those will be called cash equivalents. Whenever there's a certain risk for those short-term investment, you can no longer record them as cash equivalents. Instead, you can put them into marketable securities. Those are short-term investment, but still can be quickly sold to raise cash. We can also have accounts receivables. Those are the money your customer own to you when they purchase on account. In other words, they promise to pay you later. Accounts receivable become our assets, and for your customer, it is their liabilities, account payables, and we're going to see how we're going to record those journal entries later. Next, we have inventories, okay? Then the prepaid expenses, right? The example I mentioned is prepaid rent. Those are costs paid in advance because they are going to provide your future benefit, so they are your assets until the day they have been consumed. Then they become expense. So look, we're going to talk about journal entry later. So what are the common non-current assets? We have long-term financial investment. Those are investments that you do not intend to sell in the near future. And next we have a very important, the property, plant, equipment, or PPE assets. Those are long-term assets such as land, buildings, right, machines that you're going to use in operations. For sure they will be used for many, many years. Okay, but be careful. Some companies, they set up a threshold in terms of value of the PP assets. For example, we have some screwdrivers for sure that can be used for many years, but we're not going to report $10 or $20 screwdrivers as the PP assets because of their low value. So typically, company may set up at $2,000, for example, as a threshold. Any tools, a machine that below $2,000 will be reported as supplies. Okay, they no longer become a PP assets. Next, we have operating lease right of use assets. those are lessee's right to use a leased assets over the course of the lease terms. If you sign a lease contract, okay, with a dealer, and you got your vehicles, and based on this contract, you have this asset, long-term asset of this vehicle. Okay, that's out from the lease contract. Next, we have the intangible and other assets. Intangible assets are long-term assets, but they lack physical substances, like patents, trademarks, goodwills, okay? But they still can provide you with future benefit. So they are called intangible assets. So how do we record assets? Assets are recorded, okay, at their historical cost. In other words, based on the price we paid for them. Right? If you purchased a vehicle $20,000, then the car will be recorded at $20,000 because it's historical cost. Right? Another cost will be the market value or fair value. Right, as I mentioned, you purchased a car $20,000 because you paid $20,000, but a new model came out the next day, so your old model you have purchased, the market value drops to $15,000. Okay, so here the historical cost of $20,000 is different from its fair value or market value, $15,000. It doesn't matter. We're going to record a vehicle at $20,000. The advantage of using historical cost, because it's reliable, because market value or fair value will change every day. Right? Then the pandemic hit and the old model, the fair value becomes $30,000. Okay? So the fair value or market value, they change quickly. The historical cost is more reliable. The disadvantage, okay, the historical cost may not be relevant because if you want to sell, you cannot sell based on historical cost. It should be based on the fair value. Some assets are reported at their fair value or market value. For example, the marketable securities, they are reported at their fair values. Now let's talk about liabilities and equities. Liabilities are borrowed funds. For example, we have accounts payables. If we purchase from vendors on account, so we're going to pay them later, that become all liabilities, right? Just like we have borrowed money from the vendors. So that's account payables. We have accrued liabilities. Those are the expenses that should have been recorded but have not been paid. Like if we borrow money, we haven't paid any interest, but those interest should be recorded. And because of that, we have accrued, right? Interest payable liability. We have obligations to lenders, right? Supplies. And all these will be reported as liabilities. And equities are capital that has been invested by shareholders. So as from lecture 1, we see equity as two parts, the investment, right, or the return earnings, okay. And this is how we report liabilities and equities on the balance sheet. Just like assets, we're going to report liabilities first with current liabilities. Those are liabilities, right? Expect to be paid within 1 year. And then long-term liabilities. Okay, so they are reported based on the liquidities. And then we have stockholders' equity. Now the total stockholders' equity, and this amount will equal the total assets. Right, this amount, 53,000. $53 billion will equal the total assets. Right, so what are liabilities? The liabilities means we're going to sacrifice future benefit. It's probable. This sacrifice is probable, and the amount is known, and it can be reasonably estimated. Okay, and the obligations, right? Because we have the obligations, the transaction or the event that caused the obligations has occurred. So it's from a historical event. So, which is very important for the third criteria, which is very important. I can call you, okay, say, okay, the next week I need money, so next week I will borrow $10,000 from you. Do we report any liabilities? Yes, there's future sacrifice if I borrow, right? And amount is known, but there's no historical transaction or event because it has not happened yet. So there's no liability. So the categories of liabilities, we have current liabilities, right? These are due within a year. Then we have long-term liabilities. Long-term liabilities. Common account for current liabilities. We have account payables, right? We have seen that. Accrued liabilities. Let's say those are the obligations for expenses that has been incurred but not yet paid. We can have short-term borrowings, short-term loan, for example, and operating lease obligations. Because based on the lease contract, we can have short-term obligations to make those payments. So those will be reported. If there's a short-term obligations, there's our operating lease obligations. That's current liabilities. We have unearned or deferred revenues. Okay, one example is we can pre-charge customers, right? For example, the Tesla pre-charged customers if they want to purchase the Cybertruck, right? Those are obligations to customers because Tesla has not provided any service or vehicle to those customers. So those are obligations to the customer, and we call them unearned revenue. Eventually, when the Cybertruck has been delivered, right, it will become Tesla's revenue eventually. And sometimes we can have the current maturity of long-term debt. That's current liabilities. For example, when a mortgage payment is a long-term liability, a 15-year mortgage or 30-year mortgage, for sure that's long-term liabilities. However, the next month's mortgage payment, right, it's current. So the next month's mortgage payment will be current liabilities. Current liabilities. What are the common long-term liabilities? We have long-term debt, right? Operating lease obligations. Those are long-term obligations to make payment arising from a lease, and we have other long-term liabilities, right? For example, we have the warranty obligations, right? Deferred compensation liabilities, and other things, or even pensions to employees. Well, is a long-term liability. Reporting stockholders' equity. Stockholders' equity, we have two sections. We have contribute capital. Those are investment from shareholders, and we have retained earnings. So first we have common stock. Those are the par value of the stock issued to the common stockholders. Okay. And we have additional paid-in capital. Those are the amounts received from the stock issuance in excess of the par value. So we're going to talk about those things later, how we're going to record transactions for stock issuance. And we have the treasury stock. Those are the amount paid to reacquire the company's common stock from shareholders. And the treasury stock is a reduction of stockholders' equity. In other words, it becomes a negative number in this section. It reduces stockholders' equity. For earned capitals, we have retained earnings. Those are accumulated earnings that has not been distributed to stockholders as dividend. Right? If we never pay dividends, all the net income will be retained, become retained earnings. Right? We have accumulated other comprehensive income or losses. It's part of the earned capital. Those are the changes in equity that are not reported in the income statement. Not all the changes will be reported in income statement because certain value increase in assets, they are not going to generate any revenue or any gains. Instead, we have increase in equity but not an increase in net income. So those increase will be reported as accumulated other comprehensive income. So how does retained earnings link to income statement? So we know retained earnings will be reported on on the balance sheet, right? And net income is reported on income statement. So the retained earnings is going to connect those two statements. So the beginning retained earnings, this number is from the balance sheet, right? Plus any net income, right? This is from the income statement, or less any net loss. Okay, if we pay dividend, we less any dividend equals the ending retained earnings. Okay, this become reported on the balance sheet again. So this is how the three financial statements are linked.